Hi everyone, I'm Mike Pacito with IM Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for joining our September 2025 update on the IM Global Partner DBI Managed Futures Strategy ETF, ticker DBMF. For the last few months, we've been talking about this year's manager and strategy dispersion in managed futures. It's been historically big. Actually, we've been talking about this manager dispersion issue for quite a while, as it was one of the key problems DBI was looking to solve for when they began, and we believe it is now one of DBMF's strongest advantages. But this year, dispersion has become so pronounced that we've updated a couple slides around the topic, because people in the CTA world are talking about it more than ever of late, mostly because they have to, and so many allocators have also taken notice. So let's take a look at what's been going on in 2025. What you see here is every single manager and strategy in the Morningstar Systematic Trend category, aka Managed Futures, and their performance year to date. Incredibly, the variance from top to bottom performer has been almost 32%, with almost half of them, 14 out of 29, negative, and 4 strategies down in the negative teens. So just imagine that kind of dispersion in any other asset class, high yield bonds, large cap equities, etc. Now take a look at the performance of DBMF versus what an allocator to managed futures would most likely compare us to. Moving right to left, the SocGen CTA index, aka the largest 20 managed futures hedge funds, down 2.41%, mutual funds down less, but ETFs with more entrants coming into the space and sometimes maligned for, let's just say, lacking sophistication, well ahead of hedge funds and the majority of competing strategies. Now, as our clients know, and as Andrew wrote about in the paper he did for Hedge Nordic called The Awkward Problem with Managed Futures ETFs, we believe the ETF vehicle works very well in capturing what the asset class should deliver to portfolios. In fact, we believe it's the optimal vehicle for most investors, with some exceptions like separate accounts and swaps, which we're always happy to talk about with folks who prefer those even lower cost institutional vehicles. Now, all that's nice, but it's also quite recent. So let's zoom out and take a look at DBMF versus all of the strategies that have been around since DBMF incepted back in 2019. Now, to be fair, there was only one other managed futures ETF at that time, so the ETF peer group median doesn't tell you much. But what this really is a plug for lower fees and structural costs with a replication model in an ETF vehicle. In other words, DBMF. Take a look at DBMF versus hedge funds and the Morningstar Mutual Fund peer group. The low friction approach has solved very nicely for the dispersion problem over a longer period of time, and along those lines, solved for the frustration of many allocators to this asset class who really don't want to deal with re-underwriting an investment due to manager underperformance. Our alpha generation is designed to deliver to clients by making the beta of the space investable and refining away as much of the cost drag as possible. We think this is a big advancement and ultimately a win for allocators and investors. And we have a lot of research and data on all of this, so if you'd like to talk more about it, please do reach out as we'd love to share it. Okay, all that said, let me hand it over now to Andrew to get more specific about DBMF's recent performance, positioning, and other color points on macro and markets.
Thanks, Mike. So we've been talking about this macro environment, from extreme fear post-Liberation Day to a collective sigh of relief to risk on to downright frothy. Now, today the market is all in on the quote, run it hot trade, basically that the Trump administration will jawbone the Fed to keep interest rates low and let the economy grow faster, which will drive up equities, but at the risk of more inflation. Interestingly, CTAs embraced this trade early and, as if you look at the left column, had a banner month in September. The second macro theme is that, quote, things are bending but not breaking. Now, if you'd surveyed economists 2 years ago and laid out a list of what's happened since then, to name just a few: uncharted economic disruption from AI, a global trade war, a direct challenge to the Fed's independence, a bizarre expansion of government industrial policy, etc., not a single one would have predicted that the S&P 500 would be up over 60% over those 2 years. The economy would be fine, the inflation genie would be largely still in the bottle, etc. So the bull case is that the system, the market structure, is more resilient than the alarmist claimed. Of course, that's always the interpretation until something somewhere starts to spiral out of control. So enjoy the current ride, but remain vigilant. Now, over in CTA land, DBMF jumped nearly 6% last month, and both the SocGen CTA index and Morningstar category were up 3 to 4%. Which brings me to the final bullet. A decade after we started replicating the best and brightest hedge funds, the evidence is strong and growing stronger that we simply discovered a way to extract the highly valuable CTA signal and deliver it much more efficiently. That's the structural alpha argument that resonates more and more with sophisticated allocators. Now, here's our year-to-date performance. We're now up 6.38% this year and are outperforming the SocGen CTA index by 904 basis points and the Morningstar category by 666 basis points. Remember, this is after meaningfully outperforming both in 2024. So the last 18 months have been a very validating period for replication. Now, there are 3 points worth making on this chart. The first is that replication outperformed during the post-Liberation Day drawdown because more complex features among leading CTAs generated negative alpha. Second, drawdowns and recoveries do happen often enough with a strategy that allocators should think about how to condition clients to hold through the more difficult periods. Third, mutual funds are outperforming hedge funds this year, and if this continues, it will further undermine the narrative that you need to invest in actual hedge funds with higher fees to get the most benefit from the space. Now, on our end, we find that the mutual fund data is just as valuable as hedge fund data for extracting that CTA signal. So here's our inception to date performance from 2019. Now, over more than 6 years, we've added more than 300 basis points of returns relative to managed futures hedge funds, as represented by that SocGen CTA index, and more than double the Sharpe ratio with a correlation approaching zero point 0.9. Our strategy track record shows similar performance back to mid-2016. Now, back to my point about mutual funds versus hedge funds, the primary reason for underperformance over this period is lower vol targets during the spike in 2022. In other periods, performance is comparable. Hence, our argument is that in most circumstances, serious allocators really have little reason to deal with the headaches of investing in a hedge fund. Here's our slide on volatility adjusted positioning. The green bars are the volatility adjusted exposure of our 10 futures contracts at the end of September, and the red dots are at the end of June. This chart tells a great story about CTAs. By the end of June, after the chaos of the second quarter, risk had been cut across most major themes. Then during the third quarter, CTAs built confidence in the key elements of that run it hot trade, longer gold and oil, basically inflation hedges, a dollar recovery, well, back in the end short after the whipsaws in the euro earlier this year. Rates will remain low. Jawboning will work. There won't be a tantrum, and very bullish on equities. Next slide. So here we are with year-to-date contribution. Clearly long gold has been the most consistent driver of performance. More recently, we had gains on the equity front. Rates, of course, have been a mixed bag. The dog has been the euro, where we were short into the spike after the euro rearms trade, and fear of the flight from U.S. assets, then cut risk before the reversal. As mentioned, we're back in the yen short, which was a key driver of alpha during 2022. The good news is that by the end of September, the portfolio was up 6.28% for the year, so overall, given the volatility of the markets, I'll take it. And with that, back to you, Mike.
Okay, thanks, Andrew. So let's wrap up with long-term performance numbers for DBMF. Annualized return since inception, including the month that was September 2025, is now 7.46%. That's ahead of the SocGen CTA index by over 320 basis points annualized, and it's ahead of the Morningstar systematic trend average by over 430 basis points. Long-term outperformance against the traditional diversifier for equities, that being bonds, as represented by the Bloomberg AG, is well intact. DBMF is outperforming by over 590 basis points annualized. It's also noteworthy that that we've climbed above the AG year-to-date performance of 2025 by 15 basis points, and that's for a pretty good year for bonds this year. So we like to say that DBMF is the institutional grade fiduciary choice for the most efficient way to access the managed futures asset class. And to that point, DBMF continues to grow nicely, now over 1.5 billion in the ETF and over 3.7 billion managed by DBI in total, including other vehicles and related strategies. And for that confidence placed, we thank our clients and our prospective clients. If you have more questions about the strategy, would like further information, or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com.